sellers indicators. Most of us that know about trading will know that we have come across indicators one way or the other, no matter what. When you have come across indicators, no matter when. So the thing is, indicators are not supposed to be a major indicator for trading. What we should be looking at in trading is price action, really. So if you are able to read the chart, read the candlesticks, identify patterns and the rest, we are able to master trading. Then we can use indicators to confirm whatever we have seen on the chart ourselves. That's the main purpose for indicators. So you can see it reads, welcome to this course. We are not here to spoon feed you a strategy or sell an indicator like the educational system. Every trader has a compilation of different personalities. You are here to find yourself and what works for you. So during your research, I'm sure I put it on the page earlier on that some of us that want to research, you have to go and research about trading yourself. If you have found out that there are different type of traders, Some people are day traders. Some people are day traders. Some people are swing traders. Some people are position traders. Some people are scalpers. Some people are momentum traders. And all these designs, they take shape in every different person. Everybody has their personality. A day trader is someone who likes to trade within the day. They want to trade between the day, right? So they want to buy, let's say, the euro in the morning, and before the day ends, they want to close the trade. A swing trader doesn't have enough time, to sit in front of the PC. So a swing trader want to hold their trade for a couple of days or a week. I'm a swing trader, so I don't have to be at the back of the screen every time to check my trades. As time goes on, we'll learn all these personalities, and all of us will be able to understand what our personalities are. I'm sure some of us are trading already, so I mean, you should just try and follow up and try to see how you can integrate this course into yourself. We have position traders. Position traders are the banks. Position traders are the banks. You don't want those guys are the ones who hold position for monthly levels, monthly to yearly time frames. And the momentum traders are people who just want to get in when there's sharp price movements. They are quite the same as scalpers. Scalpers, they take trades 1 to 15 minutes, they've closed the trade. 1 to 15 minutes, they've closed the trade. And that's how scalpers do, basically. That's what scalpers do, totally. So that's just for introduction. So every trader has a compilation of different personalities. All of us have different personalities. So if you had researched well, if I was the one right now, I will try and write this down. Just write it down so that you research on them and see which one possibly fits your personality, because that's how we are going to start. And that if I knew this when I started, I wouldn't waste my time going to corners. So it's better you identify your personality now and try to work with it. And that is what is going to make sense for you. So day traders, whatever, that's the first slide. So secondly, let me just begin with the slide. So the ultimate word, a lot of people just open their accounts and they come in and they think they are going to make $1 million because they see other people do it, and that's not the case. They don't realize how hard it is, or the process and the road they are going to have to get there, which is often difficult. Trading is not easy. I'm telling you now, all of us that are listening, trading is not easy. So if you are looking for easy money, you should leave now. It's not easy. Anybody can go and click buy and sell. Anybody can do that, but that's not trading. That's clicking. If you want to trade, if you want to know how to trade, you have to work. You have to work for it. It's not something somebody tell you buy this and buy that, and that's not trading. No, that is playing. It's not trading. It's gambling. It's playing. That's what you are doing. It's not trading. So I just want to tell you that trading is not easy. Although you can make $1 million, but you'd have to get some particular amount first, because trading is about you are buying and selling money. So for you to buy some amount of money, you should have some amount of money yourself. So it's not impossible to make $1 million, but the road is long. It's so easy to lose $1 million than making $1 million in trading. Although it might seem easy, just clicking buy and sell, whatever, it is not easy. Trading is not easy. So you should know that now. You should prepare your mind. It's going to be a long road. It could be 7 months, 8 months before you finally get yourself. It takes practice. So you can be doing this for 50, 60 years, So if you be doing this 60 to 70 years, not doing anything, why can't you just take like a year, just to trade, to learn how to trade? Why wouldn't you just take like a year to sit down and trade? I've not gone to we'll jump into the charts later. This is just an introduction for you to understand. Charts is there. We'll get to see the charts. So it's normal. You can get all the knowledge you need in a month, but you still have to go out and practice to build your expertise. You still need to practice. After this course wouldn't take more than a month and some weeks. After this, you get all the information. After you get all the information, you will still need to practice on your own. All the information you have, you still need to practice over time. You can get all the knowledge you need in a month, but you have to go out and practice on your own. That's for sure. So people see trading as easy, right? So, but how long does a lawyer go to school before making $1, or a doctor, or think of how much time they put in? Doctors go to like school from kids' time, and they go to university, then they spend more years in medical school just to be able to treat people in the hospital. Why do you think trading is different? Why do you think it should be different? Because it's just clicking, buying and selling. You might think it's easy, but don't be fooled. It will take time for you to master. I myself, I'm still trying to master to some level. It's a continuous learning process. You cannot stop learning trading. Right? Good. And I just put why do you think I'm not a millionaire yet? If I'm a millionaire, by now we'll be talking. I'm just joking, right? But it takes time. I'm not where I used to be 3 years ago, but I'm far away from that. So I'm way ahead of where I used to be. Right? Great. If I'm moving too fast, you can just pull me back. The chat is there. You can just say something. I prepared this for people who didn't know about trading earlier on, just to give them a brief, but it seems they are pros already. So we'll continue. Most of us know about the foreign exchange market. So the foreign exchange market is Forex is short form from foreign exchange. And it's a global financial market for trading currencies, commodities, indices, etc. It handles on average $6 trillion of transactions 24 hours a day, 5 days a week. So the Forex market is a market that is traded by central banks. It's a central exchange of currencies in the world. So usually when you look at the news and they tell you euro is this versus this, you would see that the same amount, the same price are being quoted on the currency charts, in which we'll start exploring soon. You see that those are some of the things that they have put. Those are some of the prices that are being quoted on the currency chart. You would then, when you start trading, you would then see that the news becomes like more of a movie to you, because you were trading the price to that level. You were trading that $1.50 to that $1.56 before the news comes. Are we okay? So basically, that was how I viewed trading earlier on, and it has worked for me. So participants in the FX market are the central banks, the commercial banks, the investment banks, the corporation institutional traders, retail forex brokers. So these are the people trading the market. You are not the only one. The currency market is almost $6 trillion worth of money moving every day. And me, I have $100 in my account. What is my $100 going to do in comparison to a $6 trillion market? Nothing really. So you don't want to, when you start trading, you don't want to be arrogant in your trading, because there are bigger boys, there are bigger fishes in the market, right? So central banks, commercial banks, investment banks, multinational corporations, institutional traders, and the retail forex brokers. That's where we come in. Retail over here, retail forex brokers. This is where we come in over here. This is us when we start trading. Retail traders. Sorry. Great. So basics of exchange. Most of us already know trading. So, okay, I think Emmanuel just joined us. I want to know, Emmanuel. I want to know your trading, your experience. If you are already trading, just one. If you don't know about trading, you can just type 2. If you don't know about trading at all, type 3 in the chat section for me to know. If you already know about basics of exchange, we can just skip it. Great. So basically, this is going to teach us about foreign currency exchange. What came by? What is an exchange really? Most currency pairs are quoted against each other. When I say quote, what I'm trying to say is the pound. If you look at your MT4, your trading terminal, you see that these charts, they are quoted, pound USD, NZD USD, USD JPY. The first currency here is called the quote currency. And the second currency on every quote is called the base currency. You should know that. So if I say buy the pound, you are buying the pound. You buy the NZD, you are buying the NZD. Good. Like I said, this meeting will end in 40 minutes. So after every 40 minutes, you try to, so it won't be a lot of work. So we'll try to break it down little by little, rest a little bit, then you come back in. If I'm moving too fast, so please let me know. So let's say, for example, this is a quote, right? A quote is a currency. A quote is more of a currency. Okay, I think I have a little chart here. Hold on, guys. Okay, great. Emmanuel says he's a trader, so he knows the basics. All right, Emmanuel. All right, so an exchange for, let's say, for example, this quote, Euro USD, the price basically represents the exchange rate between two economies. Because earlier on here, you remember we said an exchange of one currency An exchange of one currency for the other, the first currency is the quote currency and the second currency is known as the base currency. Because every transaction in the FX market is an exchange here. So you should know at every point in time there are two codes. So euro and the dollar. So this quote right here is telling you that the euro is 1.1233 against the dollar. So 1 euro is $1.1233. Basically, that's what this quote is telling you. So the price basically represents the exchange rate between two economies. That is the euro and the United States, European Union, United States, right? So if euro USD goes to 13200, Europe has done better than the US. So if your initial price is 1.233, right, and the price goes to 1.3200, guys, mind my writing. This is higher than this, right? Am I right? 1.320 is higher than this. So the euro has gone up. The euro has gone up against the USD. So 1 euro is worth more than the USD when this happens. However, if price went down to, from 1.23, went down to 1.100, 1.100, this 1.100, the US has done better than the euro in that space of time that this happened. So if the euro USD currency falls to something lower than what it was before, you can see the euro has underperformed, but when it goes up, you say the USD has underperformed. Are we getting the intertwining between the two currencies? All right, great. Okay, I'm just getting some messages. Some people are having network issues, so sorry about that. Okay, the first currency is the core currency, and the second currency is the base currency, like I was saying earlier on. And so while trading euro USD, selling the quote currency euro, for example, selling the quote currency in the trade simply means you have exchanged it for the USD. So at every point in time, it's like when you go to the Forex bureau, you take $1 and you go to the Forex bureau in your local country, you go and exchange your euro, you exchange your dollar for, let's say, naira. You go in, you exchange your dollar for the naira. So you are selling the dollar to the Forex bureau person and you are buying the dollar, you are buying the naira. Does it make sense? So you are selling, you go to the Forex bureau, you sell your dollar that you've kept in the house, take it to the Forex bureau, sell it to the Forex bureau, and you are buying the naira. So this is the idea behind foreign exchange. The difference is that this doesn't happen physically. It's online. It's a standard contract. Nobody can default. It's faster. It's more liquid. It's leveraged. We'll learn about leverage soon, and everybody should learn about leverage. If you don't know about leverage and you think you have $100, you can make 1 million, you are lying. So hence, while trading euro USD, selling the core currency in the trade simply means you have exchanged it for the USD, and automatically means you are buying the USD. So the same thing happens when you are short the euro, meaning you are buying the USD. If you are selling the euro, meaning you are buying the USD. It's just the same mentality. It's an exchange. So this is what's supposed to happen, right? I hope I'm not moving too fast. So we'll get there little by little. This translates as selling the euro means you are buying the US dollar and vice versa. Basically what I was saying. So buying one pair in a quote means you are selling the other. Selling one pair in a quote means you are buying the other. So it's no matter what, whatever you are trading, the euro, pound, the naira, Chinese yuan, no matter what if you are buying the Chinese yuan, you are selling the other one. No matter what, automatically you are selling the other one automatically. So no, in every point of your transaction, you are betting two economies against each other. So if you are buying the euro, you are just saying the European economy is going to be better than the USD economy in this time frame. That's what you are saying, really. That is all what you are saying. Great. Let me just pause here, or should I? And let's just continue. Let me finish this commodity and stocks, because the 40 minutes, I have a timer here. The 40 minutes is running out. So on your MT4 charts, I hope we know what MT4 is. We have commodities and stocks also. We only don't have Forex. It's not only foreign exchange. We have commodities and stocks, and they are called futures. So I won't dive into what futures are, but not all of us trade it. I won't dive into it. So commodities and stocks are not paired together. However, they are traded in contracts. So instead of buying a standardized unit of currency at every point in time, for commodities and stocks, we call them contracts, standardized contracts. Okay, I don't have the word standardized contracts. A contract is a standardized unit of exchange in futures and options. So buyers and sellers know the exact unit they are trading on the market. With this one, there are no exchange. So for example, you can have gold. People are buying and selling gold. They are not exchanging, just exchanging money. If you buy, you are buying, for example, gold has like a 50 standard unit. So at every point in time, you are buying 50. 50 is the lowest contract of gold that you can buy. So you are buying 50 at every point in time. That's what you are doing. Are we good? So sugar, coffee, and silver, those are futures. And we have options. Chan trades options. So these are some of options, but options are in different assets. Options are we have currency options. We have futures options, and we have options are just hedging tools that they are hedging instruments which their prices are derived from an underlying asset. So options are copied from the price of options are copied from the actual asset itself. So if the euro is trading at 1.2, the options of euro will also be trading at 1.2. So Chan, I'm just trying to tell you because you trade options. So contract size differs with each commodity. So like you said, a contract is a standardized unit. It's like when they say if you are coming to buy egg here, you are only buying the least you are selling is 5 crates. So no matter what, every future contract has very different units of they have standardized units of contract. Every future has every one of them have different standardized units. So for example, gold has a different contract size. S&P 500 has a different contract size. Coffee, sugar, each and everyone has a different contract size, right? Right. So Chan just sent me a message. I was just checking out. So contract size differs with each commodity and instrument, no matter what. All of them have different. So you need to have different type of accounts and different type of sizes of money to be able to trade them. Some brokers won't allow you to trade gold because your money is not enough. So that's just by the way. Therefore, instead of an exchange, you will be long or short a specific amount of contract at a point in time. So if you are trading commodities or stocks, futures, you are buying contracts. Although Forex too, we are buying contracts, but it is not standardized as much as it is standardized with the commodities and the stocks, right? So breaking it down, the basics of exchange. I was hoping lots of people would join today, but I think it's great since we have like, I think 8 people here. It's awesome. So sure, you've heard of pips and pipettes. Um, a pip. I think we know what a pip is. Wale, I think you know what a pip is. I'm sure. A pip is a. Let me just check out this chart, guys. Hold on. All right, I can see that. So uh, a pip, you when we start trading, you hear a lot of pips and pipettes coming out of my mouth, and wherever you read about forex, you hear of a lot of pips and pipettes, right? Okay, Empress says she doesn't know what a pip is, so we'll just take it back for Empress. So a pip stands for percentage in points. It is the smallest unit of price, usually the fourth decimal. Some currency codes are in the fifth decimal. The fifth decimal is called a pipette, the fraction of a pip. So usually, when you see a currency code like this is a Euro USD 1.1051. The fourth decimal place is called the pip. The fourth decimal place is called the pip. So if, for example, the pound USD is 1.405 to the fourth decimal place, 1, 2, 3, 4. This is a pip. So if from this 1.4053, this currency moved to 1.44052, this is a 1 pip move. Are we okay? Equals to 1 pip move. Because this minus this, the fourth decimal minus that fourth decimal, that's what it's giving you that. Are we okay? So the pip is the fourth decimal place of the currency code. The same thing happens here. We have what we call the pipette also, or the pipette. Some people call it the pipette. Is the fifth decimal place. Some people give you, but mostly the standard is the fourth decimal place. Some people will go as far as giving you the fifth decimal place, but it's fine. But all you should keep an eye on is the fourth decimal place. So if I say, oh, I bought Euro USD today and I got 5 pips, you should know I'm saying, oh, the Euro USD went up 5 pips, right? There will be a video. I'll just post it up for you guys so you can go back, and it's just an introductory video, and we'll still go deep into it. So for example, if the Euro USD moves from 1.1051 to 1.1052, that is 1 pip, right? So meaning it is 0.00001. So this minus this, like I did earlier on, this is it. If the Euro USD move from this 1.1051 to 1.1060, that would be a 9 pip move, 9 pip. I did the math for it. I wanted everyone to answer, but it's fine. Empress, are we good at least? So pip is the fourth decimal place. Fourth decimal place. Fourth decimal place. So alternatively, some brokers provide the fifth decimal, which is known as the pipette. it is the fraction of a pip. So a pipette is the pip broken down. So this one and this one will have to turn to 9 to give you 1. When you read more, I don't want to go deep, you might confuse you. It's not needed really. You might, if you read it deep down, you'll definitely understand it. So a pipette is a fraction of a pip. So if 1 pip is 100, so if 1 pip is 100, a pipette would be 1,000. So 1,000 pipettes will make a pip. So if a pip is 1, a pipette is 10. So a pipette to 1 times 10 will give you 1 pip. I don't want to go far to it, but this number right here, to give you a good view, this number right here, this 3 right here, has to go to 9. 9 before this one will change to 5. So then you have 1.3050. And this is a pip. So basically that's it. I don't want to go deep into it, but all what you should know is the 4th decimal place is called a pip. Nice. So I want to pause here. Let me just pause, stop the video. Let's chat and see what you have learned so far. Then we come back. I don't want to go into to rush it very, very fast. So I'm just going to end the meeting in like 5-10 minutes. We'll join back again and we just, you know, see how far we've gone. If that's all right, guys. All right. Compared against the big currency, that's the dollar. And we have a very bad dollar situation in Nigeria and Ghana also, basically. So when the dollar is moving higher than the Ghana cedis, it's something that is moving it. It's not just moving, right? It's economical. It's inflation in Nigeria that's causing the dollar to rise more than the naira in Nigeria, because if Nigeria is not managing inflation very well and the US is managing inflation very well, and we all know that inflation is not good for any currency. So the Nigerian currency keeps increasing against the dollar. Basically, and the central banks are also in the forex market, the exchange currency. So depending on the situation in different currencies, the central banks will decide, okay, because the dollar is more stable, I want to buy more dollar. I want to keep most of my country's currency in dollar because dollar is stable and they manage their economy very well. And because of demand for that dollar, it increases. The value for the dollar increases. We all know now. So if demand is increasing in a particular sector, people take advantage of prices go up. So basically, I just wanted to give you, although it's not only inflation, there are other factors that affect the market. So for prices to go up and down in this particular time frames, you should know that there are forces in play. That's all I want to let you know. There are forces in play. Great. So what moves the market? The answer is, in total, demand and supply. How I would come and whatever happens to make demand increase and whatever happens to make supply increase in a particular currency is what is going to make the prices move. So in all, we can summarize it to demand and supply. Whatever is going to happen, inflation right now, the example I just gave, will make demand go up against supply. So there are other factors which we look at. So what causes market participants to buy and sell? Earlier on, we looked at market participants, right? Market participants are the central banks, the hedge funds, the institutions, the Forex market is a $6 trillion market. So I'm mentioning the central bank because they form the biggest part of the Forex market. They are the one exchanging Nigerian money for Ghana money, for they are the ones doing the big transactions of money. So what causes market participants? The market participant, although we are also part, we are the retail traders, we are also called speculators. Okay, Chan, let me just hold on. I think Randy just joined in. He wants to ask a question. I will just let me just finish up, Randy, with this slide, and you can ask a question. That's okay. That's fine. So what causes market participants to buy and sell a currency, asset, or commodity? Remember, we didn't only look at currency, we look at stocks, we look at commodities and futures and forwards already. So all this, there's a particular person somewhere that is analyzing this central bank somewhere that's analyzing this country's currency at every point in time. Everybody is trying to move their money to where it's good. So what causes market participants to buy and sell, this asset at a particular point in time? So economic factors like interest rates, the gross domestic product, inflation value, consumer price index, production growth. So when traders look at economic factors, they are searching for one keyword: growth. When growth is not existent in a currency, the currency will fall. That is, they won't demand it. If your country's currency is not growing. Earlier on this year, I think last year, 2018, the Ghanaian economy was doing very well, and people were demanding to put their money in Ghana. If you look at the Ghana Stock Exchange, the chart was so up. Everybody was, even Bloomberg was talking about Ghana Stock Exchange. You understand? But right now it's so bad that we don't even know if Ghana is there anymore. So if there's no growth in the economy, that is what happens. People will discount the demand and supply to buy or sell the currency that they want, and the asset, the commodity. The same thing with commodities and stocks of a company. If you want to go and buy stock in a company, you want a company that is doing well, right? So if a company is not doing well, you can't buy their stock. What are you buying it for, right? So you have economic factors, interest rates, like what I just said. Okay, so Randy, you can just put your question there. Let me read it out to the group. Okay, while Randy's typing, let me just continue. So, Empress, I'm focusing on you because you have very less experience in the market. When you are trading, earlier on we spoke about pip. Now we are talking about a lot. A lot, when you say a lot, one lot, two lot, in the past, Forex was only traded in a specific amount. I don't want to give the history because it will take too long. Maybe during the chat sessions, I will just put it there. In the past, spot Forex was only traded in specific amounts called lots. They are traded in specific amounts called lots, or basically the number of currency units you buy or sell. To give you a good example of a lot, when you go to buy maybe drinks, soft drink, let's say Coke, you are buying it. When you go and buy, you say, okay, 24 Cokes is called a crate. A crate is an addition of 24 individual Coke drinks. That's what we call a crate. So when we look at currencies, a lot is 100,000 units worth of currency. A lot is 100,000 units worth of currency. Like the Coke, the 24 Cokes make one crate, right? So 100,000 units makes one lot. 100,000 units makes one lot. 100,000 units makes one lot. So 100,000 equals one lot. So basically, that's what a lot is, right? So you have to keep that in mind at every point in time. Okay, let me just go to Randy's question real quick. Randy's saying, so from the first answer, does that mean that when you understand demand and supply very well, you can succeed in the Forex market? Yes, yes. Like you didn't join the class earlier. We talked about different type of traders. Of course, when you understand demand and supply, you can trade the market very well. There are different ways people trade the market. We'll get to that. We'll get to that. But what I'm trying to tell us is why prices move. Why do prices move? You as an individual investor can't get the information that the banks are getting. So you won't be able to pay for somebody to analyze the whole economy of Ghana for them to for you to know, okay, I'm going to buy this amount of currency in Ghana cedis. Even if you buy the amount of currency in Ghana, how much are you going to buy? Because the forex market is a $6 trillion market. So how much do you have, Randy? How much do you have that can cause demand of the Ghana cedis to go up, right? So I was just joking, by the way. So I'm just trying to tell us why when these banks, no matter what you have in mind, no matter the technical analysis, in the end, it's people that discount information, is the hedge funds, the bank. If they don't buy, nothing moves, right? So for them to buy and sell, there's something going on underneath, right? So that's by the way. I hope I answered your question, right? Great, great, great. So what is a lot size? Empress, back to you. We talked about a lot being 100,000 units of currency. A lot equals to 100,000. A lot size practically it is the amount of currency you trade expressed in decimal. So if 100,000 units equals to 100,000 units is one lot, and it's called a standard lot. 10,000 units is 0.10, and is also known as mini lot. 1,000 units is 0.01. Empress, you need to know this. Expressed as a micro lot. And 100 units equals 0.001, expressed as nano lot. Nano lot. So it's so simple. When you are able to know what one lot is, if I say 100,000, you know it's one lot. When I say 0.10, 0.10, a mini lot, micro lot. So we'll be using these terms very well, very often. So you need to, it's hard to learn new stuff, but when you finally get it, it's great. So you just need to put in the time. So standard lot, mini lot, micro lot, right? And the nano lot, the small one, is not needed. So you don't have to disturb yourself about it. The standard lot, the mini lot. And this incremental change in price, it can make you a lot of money depending on the money you have. So it all depends on how much money you are able to buy and sell in a particular point in time. So that's the lot size. When we start, I'll be using these words a lot. What is a position? A position is the total amount of currency unit you have vested in a single trade. So let's say when I ask you what's your position size, what's your position for Euro USD? You could say I've positioned 100,000 units, right? Or I've positioned one lot. So basically, that's what position is just telling you. So a practical example, okay, what is your position size? I bought one lot of Australian dollar and the US dollar, and that's 1% of my equity. So that's your position. That's the position. That's the total amount of your capital you have in this particular trade at a time. So how much of Ghana cedis are you buying? So the amount of Ghana cedi you are buying will determine your overall position. I won't go deep into it. I'll just brush through it. Sorry about the network. Sorry about the network. So a position is the total amount vested in a trade expressed in loss value. In some cases, expressed as a percentage of your equity. Fine. Earlier on, we talked about PIP. What is a PIP? Talked about PIP, the PIP being the fourth decimal place in a currency unit. So I'll just, for reference sake, I'll just put it down. So Euro USD equals to 1.2345. And it went up to 1.2346. That is equals to a 1 pip move, or 0.0001. It's very easy. So a pip value is the cost per 1 pip movement in any given asset. So this is 0.001 right here. In every currency, it costs something. So if 1.2345, if it moves to 1.2346, depending on the amount of lot you buy, depending on the lot size you buy, every pip value, every pip has a value. Every currency, the euro, the pip value for euro is different from the pip value from the AUD USD. Every currency, every incremental move in the price of a currency has its value. If the Ghana cedi's US dollar move from 1 to 2, it will cost you more than if the Ghana cedis and the naira move from 1 to 2, because they are different. They are different. They are different currencies and they have different economic values. Okay, Empress says she has a question. Yeah, Empress.
Okay, so you said that if it increases, maybe like 2, 3, 4, 6 becomes 2, 3.
Your network is really bad. If you can just type out the question, I think it would be great. Empress, we can't hear you very well. Can't hear you at all.
Is 1 pip move. How about when it decreases, like 1 point?
Whichever, okay, if I heard you right, if it moves up or down, no matter what, you need to calculate the 4 decimal place. If it goes up or down, whichever way it goes, it's a pip move. No matter what, it's a pip regardless whether it goes up, whether it goes down, it's always a pip move. If that was your question. So Gideon, please. I think Empress is typing a question. So Gideon wants to ask a question also. Please, Gideon, go on. Okay, Empress, nice. Gideon, you can talk. I think you've unmuted yourself. You can talk. Okay, Gideon came late. All right, let me just continue while Gideon thinks about his question. What is a pip value, right? A pip value is the cost per 1 pip movement in any given asset. So if you had already downloaded your MT4 platform, you see that there are different currency codes. There are different codes in the currency. There are different codes in the currency. So every currency code has a different P value. If euro and the dollar move from 1 to 2, it's a different cost from euro and pound. And like that, every currency has different values. Every currency has a different value. But most of the time, the US dollar quoted pairs, the ones quoted with US dollar, which US dollar is the quote amount, has a $10 value. So that is if you are buying one lot of US dollar, if you are buying one lot of any euro US dollar pair, it should cost you $10. It should cost you $10. We'll dive into that. It might sound a little foggy in your ear, but so if the euro USD move from 1.230 to 1.2035, so you can see from here 1.2030 to 1.2035 is 5 pips. The difference is 5 pips, and because it's the dollar is the base currency. That 5 pip, $10 times 5 pips is $50 in profit. So if you had bought one lot of euro dollar and you moved 5 pips, you get $50. If it also goes in a loss, you lose $50. So trading is not easy. You should know that. Considering you've bought one standard lot, that's if you have bought one standard lot. So if you didn't buy one standard lot and you bought one mini lot is 0.10. So you have to do 0.10 times $10 times 5 pips. I'm not very good in maths, but you can do that. So depending on one standard lot, depending on the lot in which you buy, you get the amount, the value of the pip you are looking for, right? I'll share a resource soon. It will tell you the amount, the value of every currency pair. So you guys can use it whenever. Now, this is a very important session we have got into: leverage. Leverage. I used to watch a series called Leverage. I'm sure most of us know the English word leverage. Leverage just means borrowing. Borrowing. You are borrowing, big time borrowing. So leverage in Forex or in the financial markets is debt. We say debt, right? So leverage, it is the total amount of money a broker has allowed to lend the account holder to be able to trade 100 units of currency. You will see that before you open a trading account, when you start, I think I have a link there if you want to open a trading account. When you are in the process, I need to mute a noise that's coming into my head too. Okay, I think it's gone now. So when you start trading when you start opening an account, every broker will provide you with leverage. So some will give you leverage of 1 to 100. Some will give you a leverage of 1 to 100. Some will give you 1 to 200. Some will give you 1 to 5,000. Some people give you 1 to 5,000. That's crazy. It's a lot. So what this is basically telling you is that for every $1 you have in the account, for every $1 you have $500. That is what leverage means. So if I have $200 in my account, if I have $200 in my account, and I've chosen 1:1,000 leverage. It's very important. It means for your $200, for every $200 you have in that account, you have 1,000 more. So your total amount you are having the total amount you are having in the account, the imaginary amount you're having in the account is 1 times 1,000. 200, which is what you have times 1,000. And that will give you, I'm not good at math, so I think it's 2,000,000. So that is $200,000 in your account, which is also the same as 2 lots. Empress, does it make sense? I want us to get this part very well because it's very important. Lots of people fail because of leverage. I hope I'm making sense though. Good. So $200 in my account, and I've chosen a leverage of 1,000. 1:1,000. So what the 1:1,000 is telling you that you are borrowing 1,000 more of all the 200 you have in your account. For every $200 you have, you are borrowing 1,000 more of that 200. So 200 times 1,000 equals 200 units of currencies. It's the same as 2 lot sizes. So what the broker is telling you is that you can trade and take a 2 lot trade in your account. The highest you can go is 2 lots. So leverage is telling you you have borrowed money. So over here, it is the total amount of money a broker is allowed to lend the account holder to be able to trade 100,000 units of currency, right? Some people like high leverage, some people like low leverage. I'm sure if I ask all of us, do we enjoy? Would you like to trade with borrowed money and lose it than trade with your own money and lose it? Which one would you go for? Your own money or the broker's money? Which one would you like to lose? The broker's money, fine. We want to lose the broker's money. It makes sense, right? But this is the real deal. The broker is giving you this in your mind. There's nothing like that. They are just trying to make you spend more of your money. They know you are new in the market. You are eventually going to lose it, right? We'll get to that. So it takes us to the other thing, which is called margin. The margin is the money that the broker requires you to deposit. The margin is the total required amount of deposit that the broker allows for providing leverage. So in this example, $200 is your margin. $200 is your margin. So all these are just financial jargons. They just want to confuse us. The margin is the amount you deposited. The leverage is the amount you are borrowing. So the 200 times the 1,000, your leverage will give you the total trade sizes you can take. It will give you the total, or the actual total money you have in your account. That's what the margin is saying. We all need to understand this very well. It's very important. Leverage can kill you in the market. You can have $1,000 in the market. You can have $1 million if you over leverage your money. If you borrow too much on that $1,000, you go out of money right now. Great. So let me just erase that. I'm sure we all got that at least. So basically, leverage is borrowed money. And I'm sure we agree it isn't our money. If it isn't our money, we won't lose more, right?
Can I ask a question?
All right. Then please go
on. The leverage, I don't want to bring you back, but please, can you go back?
All right. I'll just so leverage is basically the money. Okay, let me take you back to the story of let me take you back to how the whole marketing started. So we know through history that Forex trading is not for individuals. Forex trading is for banks. It's for the central banks that do it. And what the central banks do is they trade in 100,000 units. The lowest amount of exchange, the lowest amount of currency they exchange is 100,000. The lowest amount of currency they exchange is 100,000. So if you don't have 100,000, at least your last cry 100,000 before you can buy and sell the currency, $100,000. So now the brokers have come in. Your broker has come in and they have broken these 100,000 units down to small units for us, right? To us, the laptop users, the phone users, that okay, you don't have 100,000 units. You don't worry. If you have $200, I'll give you 1,000 times your $200. So it will be up to 100,000, right? If I give you 500, you bring $1,000. I'll give you a leverage of 100. A leverage of 1:100 for you to complete 100,000. That is leverage for you. So the broker is the one providing leverage, and leverage is the amount, just a fancy name for the amount you are being borrowed to trade 100,000 units. The amount I've been borrowed to trade 100,000 units of currency. That is what leverage is, and that's the history right there for you. And the margin, that 1,000 that the broker said, come and deposit, will give you leverage on top. No? That is what is called the margin. Your deposit is called the margin. Deposit is called margin. But I hope I'm clear. Okay, great. So let me just move on. With time, we'll dive deeper into it. We'll dive very deep into leverage. We need to know about leverage. Everybody needs to know about leverage. Because all of us, we are trading on leverage. If we start trading, we don't have enough money. We all trade on leverage. Wow. Okay. I didn't do the slide though. Let me just start from the beginning for you guys. So what I said here is leverage is designed to make us lose. How? So leverage is a double-edged sword. While it has the potential to magnify traders' gain, it certainly has the potential to magnify losses as well. In fact, the greater the leverage, the greater the risk. Both trader A, okay, so let's take this example. Right? Are you guys all with me? I mean, I'm not talking into the air at least. And I'm not moving too fast. I think Empress is gone. Okay, but the boys are here, so no problem. All right. Okay, Empress is here. Okay, Empress is here. All right. All right, I think Empress is here. So I will just continue. So leverage is designed to make us lose, right? So let's take this example. We have an idea of what leverage is now. I don't want us to go too deep, and it will be as if it's more of talking and talking. I don't want to be that way. So both trader A and trader B opens an account with a broker. Let's follow this example. And they start trading with the same capital of $10,000. So trader A utilizes the leverage of 1:100. On a normal day, you should start calculating that. He has $10,000 and he has a leverage of 100:1. So meaning for every dollar he has in his account, He's having 100. So 10,000 times 100 will give him what? Blah, blah, blah. It should be there. That's for trader A. And trader B uses a leverage of 10:1. You see, they both have the same size of account. They both have the same money. But trader A is leveraging more than trader B. So both traders then decide to sell Euro USD because of whatever reason is here. Because of however you see, okay, you know the euro, you think the euro will go down because of this. So traders A total contract size is 1 million. How is it 1 million? How did you get the 1 million? We got the 1 million by multiplying the $10,000, the margin, times the 100. So 1 million. 1 million worth of currencies, which is also the same as 10 lots. 10 lots. Don't forget our calculation. It's also the same as 10 lots. That's for trader A. If I'm wrong in my maths, please let me know. So trader B total contract size, he has $10,000 also, but he has leveraged 10. And that is 100,000. He has, so 100,000 units equals to 1 lot. Right? So we are following both of them. Trader A has leveraged more than trader B, right? But surely, if, for example, we already said the Euro USD is 1 pip equals to $10 for a standard lot, right? So if the trade goes against them by 50 pips, okay, let's say if the trade goes for them by 50 pips, both traders will incur the following losses. Trader A will be 10 lots, the 10 lots here, times the 50 pips, because the trade went 50 pips for them, times the $10. I think I mixed the A and the B together, but you just interchange it. So in total, trader B, no, not trader B, sorry, trader A will be losing $5,000, right? And trader B, 1 lot times 50 pips times 10 will be losing $500. The same way, if the trade went for them, trader A will be making $5,000 and trader B will be making $500. Let me give us another example. That example wasn't very clear. I also felt it wasn't very clear. So let me take us to this very simple whiteboard here. Okay, I can't find it. Okay, I'll just do it on the side. So here, let's say, where is the okay. I have a question. Okay, someone has a question, please ask.
If the money was for the trader A,
yes,
if it wasn't level, the gain would be $5,000, right?
Yes.
And if trader B, the money was also his, the gain would be $500.
Yes. So trader A has utilized more leverage than trader B. So if trader A wins, is losing 5,000, is winning 5,000. if trader B wins, is winning 500. But trader A has used more borrowed money. He has bought more because he has leveraged more. And trader B, the same thing. So if they lose, trader A will also lose more and trader B will lose lesser. Let's take another example real quick before the next 45 minutes runs out. So, for example, let's say, okay, I and Empress has $500. I also have $500 in my account, right? And we both leverage 1:200. Please follow my math. So I'm not very good at math. So if I make mistake, just let me know. So I and Empress both have $500. Our margin is 500, and we have both choose the same leverage. The same leverage, 500 to 200 leverage. Right. So right now, 500 times 200 would be, I think, 10,000. Am I right, please? Or is 100,000? 5 times 2, 10. 1, 2, 3, 4. 1, 2, 3, 4, 1. Okay, I use 100,000. So Empress has 100,000. I also have 100,000. So both of us, we can spend 100,000 worth of currencies. That is the same as one lot. So both of us have one lot to spend on a particular currency. Now, if I decide to buy one mini lot of Euro USD, or the same thing at 0.10, of Euro USD. If I decide to buy 0.10 mini lot, 0.10 of Euro USD, and Empress decided to buy one lot, or the same thing, one, it's the same thing, right? So that's me, and that's just follow my example very well. We want to get a good sense out of leverage. And me buying 0.10, the Euro USD went for me 50 pips. Let's say we all win 50 pips. It goes for me 50 pips. So 50 pips times, and we know that the pip value for Euro USD is $10. Don't forget, $10. Pip value for Euro USD is $10. So $10. If we multiply this, we should be getting around, please, what are we getting? I think 50, right? Am I right? 50. If I'm wrong, you can correct me, please. But if Empress buys one standard lot times 50 times 10, the same thing. We all did the same thing, but I'm buying one lot. No, Empress is buying one lot, and I'm buying 0.10. Follow me, please. I don't want to get you lost. Right? One lot times 50 times the pip value. That is 10. I should get 500. Empress should get 500. So what has happened here? What has happened here is that Empress has made $500, which is 100% of my account, of her account. And me, I have made $50, which is $50 of 500. Remember, we both had 500 in our account. We both had 500 in our account. So 50 of 500 is, I think it's 10%. 10%. So I've made 10% of my account. Now Empress is happy because she has made 100%, because the trade went in our way, right? So let's say this trade didn't play out and we both lost 50 pips. We lost 50 pips. The same 50 pips. Empress will lose 100% of our account. But I would only lose 10% of my account. Can you see the idea between leverage is good. When it goes for you, it's good. So in this very short example, you see that Empress lost all their money, while I only lost just $50 out of my 500. Did we get that part? If you are not clear with that part, just pull me back so I can just clear it up. So what all the jargon means is, the more you borrow, the more the potential for the more your potential for losses. Okay, Empress is asking what the margin is. The amount you deposited. The margin is your initial deposit. Margin is your initial deposit. So we both had the same margin. I and Empress, we both had the same margin. That is 500. The Empress leveraged more than me by buying one lot, and she lost $500. Before you take any trade, you need to do these calculations. All these calculations need to happen, unless you lose your money. So before I trade at any point in time, I calculate everything. We'll get there. So basically, I'm just trying to give you an idea that leverage is not good. If you are trading and you have $100 in your account, don't go and buy one lot. Don't go and buy two lots. Don't go and over leverage. Great. All right. So I just wanted to take us through the trading platform. I think this is the last slide in the platform. This is the last slide. Okay, I think I have a question here. No, if you are looking at the chart, someone is asking if we should leverage with care. Yes, that totally makes sense, because no matter what, I don't have $250,000 in my account. I don't have that, right? So what I want to do is leverage the smallest that I can. If you over leverage, because we are all trading on margin, we are all trading on borrowed money, all of us, all the people on the laptops, except the hedge funds, those people who have more than a certain amount of money, those are the ones who are able to have trades that are not without margin or without level. So leverage with care, Empress. Leverage with care. Trade with care. Don't be greedy. People get greedy and they buy everything because it's going their way and they end up losing it. That's the main reason why people lose money in the market. They forget about leveraging. They forget about leveraging totally. They don't know what leverage is. They don't know what margin is. A lot of traders don't know what margin is. I can tell you when I started also, I never cared about this, but you should care about it. It's good when it's making money for you, but it's very bad when it's not. And please, I would like us to use our PCs. When the next classes, it will be more intense. The phones won't be enough for you to learn trading with. I won't lie to you. Your phone won't be enough. So it's either you get a PC and connect it to the internet. The phone won't be enough. So yeah, I want to show us around the MT4. I'm sure some of us have it already, but I'm sure you have the MT4, right? So let me just clear this. I think we didn't even use up to 2 hours on the. So let me just clear this out of the.
Hello, Mufta, please, you are talking to me.
Yes, sir, I was asking if you had the MT4 on your PC.
No, it's the meter trader I have.
Yes, it's the same thing. MT4.
The same thing.
The same thing.
Okay. I have it, sir.
Okay, great.
All right, thank you.
So basically, this Empress, if you have this on your PC, this is a typical of my chart. This is how most of my charts will look when you look at it. So over here, you will see, here is the market watch. We call it the market watch on the left. The market watch. The market watch, it shows us all the currency pairs. It will give you the quotes. You can see what we're discussing earlier. AUD, USD, Euro USD, Pound USD, USD CAD, USD Chef, USD JPY, AUD JPY, Euro AUD, AUD, Chef JPY, Euro Pound, Euro JPY, Euro CHF, Euro NZD, Euro CAD, Pound Chef, Pound AUD, Pound CAD, Pound JPY, CAD JPY, Pound NZD. So this is the market watch. It gives you an overview of the market, And we have your charts here. Basically, this is how charts are. Up and down, up and down, up and down. These lines are called trend lines. Let me try and use an actual chart for you guys. Just to end the class, let me try and use an actual chart. So this is basically my charts. These are how my charts are. This is the market watch. You can see that the time is still ticking, meaning the market is the pound, euro pound, everything is here. For at the top side, these are the lines that you see on the chart are what we call trend lines. These are trend lines, and you can select them by pulling them from the top. All the menus are here, the charts, the lines, you can get them from the top here. And these are the tools we use to analyze the market. Let me tell you something. Earlier on, we talked about demand and supply and whatever. Most traders, majority of traders are technical analysts. Technical analysts or technical analysis is a fancy word for saying we read the charts to trade. That is what technical analysis is. We read the charts to trade. We read the charts to trade. And we have people called the fundamental analysts. The fundamental analysts are people who go and study the interest rates gross domestic product, inflation data, consumer price index. Those are the people who do that. Those are fundamental analysts. And those of you that think you see the news and trade it and you call yourself fundamental analyst, you are lying to yourselves. That is not fundamental analysis. That is gambling, right? That is gambling. You are not fundamental analysts. Fundamental analysts, they compile data before time. They compile data before time and enter the market even before the news breaks. Those are fundamental analysts. So if you think you are gambling with the news and you think you are a fundamental analyst, you are lying to yourself. So most people with PCs, like me and you, we are technical analysts. And what we do is we look at charts. We look at this and say, okay, it's going up. It has done this. It has done that. And that is what I'm coming to teach everyone over here. That's what we'll go through throughout today, throughout the time we are going to finish. But I hope my data don't finish. If my data finish, we are all gone. Just joking, right? So basically,
The data cannot finish.
So I'll try, we'll go through it. It won't be easy, but we'll go through it. So let's just try and keep up. At the top, we'll see that we have, even when you put your cursor on it, it should tell you what it does, right? So over here, you see that it's saying monthly, weekly, whatever. So we have the time frames, we have indicators. We have indicators, stochastic oscillators, for example. We'll learn about those. We have different indicators. And what these indicators are doing is confirming price. They are confirming price. Indicators are no price action. They are used to time the market. They are used to time the market. We have different type of indicators. We have lagging indicators. All those things, see, what I'm going to give you, I'm not going to, finesse it and try to make everything look complicated. Although you might think you've heard something somewhere which I didn't mention. That is it. There are a lot of things, but what I think is relevant is what I'm going to go through. After that, then maybe you can start reading somewhere else. Fine. But this is how I want to do this, and let's see how it plays out. Right. So basically, this is the chart. I think I didn't mention everything on the chart for you guys. So we have what we call the moving average. Is the small line, curly lines you are seeing. They are lagging indicators that are used to understand price trends, basically. We have the Fibonacci tool. The Fibonacci tool is this thing here. We'll learn about all those. Horizontal lines, we said that already. And basically, this is it. This is just the whole thing. This is just the whole thing. I think we'll end the class here. If there are any questions, I'll just give us like a few minutes to ask questions, then we go, if that's fine. That's the end of the introduction. This is just an introduction. And make sure you understand leverage very well, leverage and margin. It's very important. Most people don't. So I'll take any questions if there's any, and if not, let me unmute everyone. I can't. So guys, any question, please? All right, guys, I think there are no questions. If anything, we'll continue on the Slack group. I'll add you all, guys. I'll add everyone to the group, and I'll share the video link for anyone who.
Are we meeting tomorrow?
Okay, who has a question, please? Let the person who has.
I'm asking you. I'm asking if we are meeting tomorrow.
I think you are new to the group. Tomorrow we are.
I am okay. So
every second day of the week. So Monday, Wednesday, Friday. Monday, Wednesday, Friday.
yeah. Okay.
So who else? Any other question, guys?
All right.
Sorry, is it compulsory for me to have a laptop?
It's not
So-
compulsory. It's not compulsory.
It's for your own good.
It's yes, exactly. For you to able to be for you to see what you are doing clearly, for you to have a bigger view. But if you
Yeah.
think you can learn it with
For convenience.
yes, it's for your convenience, exactly. If you think you can, fine, that's fine. I mean,
All right. Thank you.
all right, guys. I don't think there's any other question on anything we did. If not, yeah, thanks everyone. I thank everyone for attending the class. Yeah, thanks so much. See you sometime soon. And expect assignment.
All right, thank you too.
Expect assignment. All right, bye-bye.
You're welcome, sir. Bye.